Good morning and welcome to Agricole's live presentation on everything that you need to know about private equity before IPEM.
I'm Olivia Zitouni, the Group Head of Commercial Team at CACEIS Private Equity Real Estate Solutions.
And I'm Stephane Barret, Head of the Private Capital Group at CACIB. Hope you all enjoyed a great summer, but now we have to get back to work here, and clearly we would like to select a few items, hot topics, to raise with you about everything that has been happening in the last 12 to 18 months, and maybe give a view a bit on the forecast of what could be happening.
Indeed. Stephane, as a senior banker, how do you perceive the impact of the macroeconomic environment on your clients?
Well, it's been a very complicated time. I mean, we've had COVID, that was a brutal stop. Post-COVID, we had fantastic expansion. Really, the multiples were growing very fast. The growth of the top line of the investment portfolios were doing fast. And rotation of funds was at ever-growing speed. And all of a sudden, we hit a big snag. That was beginning of 22, 23. And clearly what happened is that during Ukraine, that impacted a large crisis on the supply, on inventory. And clearly, all the companies that were working on the sector had a big impact. The subsequent impact of that was interest rates, which grew a few months later. And so we've been in an environment which has been not conducive to transactions. The debt markets have clearly slowed down in concerns on risk and liquidity that could happen on the transactions. Have margins decreased? No, not really, but there is a general expectations that margins will continue to decrease. Inflation continues to be high. There's pressure on the producers, there's pressure on the consumers, there's pressure on the client base. And in all this, we have one additional problem, is the fundraising market. Institutional investors have long time been a big investor in the industry, whether it be in private equity, in infrastructure, real estate, but also in venture and growth. And today we find ourselves in a situation with the famous denominator effect that we all know, in which valuations have come down, but the exposure of our large institutional investors has stayed very high. Some sectors are over 50% allocated to the sector of alternatives, which means that institutional investors have decided to clearly slow down dramatically the amount of investment funds that they put to work. So that's clearly going to have an impact, and we'll discuss that with Olivia in the coming moments. That has had an impact in terms of amount of funds to be raised. The subsequent impact is the valuations, the coming down of valuations. The high interest rates have created a gap between seller expectations and what a buyer of a new deal is looking for. So we have a very significant valuation gap. We have a liquidity gap in the debt market. We have new entrants that have been putting in on the syndicated market. We have credit funds, we have uni rates, a whole bunch of new entities, and a lot of new players have come into the industry, making it a lot more complex in terms of environment. So these are some of the items that we would like to raise with you, including slower rotation, lower valuations, and what's going to be coming up next. If we can't sell the portfolio companies, if we can't reach the valuations that we want, we can't give the money back to our LPs. That is even more slowing down the system. So, as a pan-European depository bank, leading pan-European depository bank, what have you observed on the fundraising market, Olivia?
I will totally elaborate on what you said. We have experienced an extension of fundraising timelines since summer 2022, and notably we have seen a sharp decline in terms of real estate projects. However, GP came back in the market beginning of this year with new projects concerning private equity, infra, private debt, secondaries. And an EY survey of private equity in the second quarter of this year, we have a total of 209 billion euros of fundraising, which mark a significant decrease, a 16% decrease compared to the same quarter of last year. But this was anticipated by GPs. According to an S&P survey, 45% of GP executives have anticipated that the conditions of fundraising would have deteriorated in their location this year. And our own data shows that institutional LPs have decreased their investment ticket, sometimes up to 50%. Therefore, the fundraising environment was more competitive, and our clients have made a tremendous effort in terms of fundraising this year. There was a clear flight to quality. The latest fundraising of CVC is a clear example of this. But for small, mid-size GPs, it was more difficult. They had to stand out from competition. They tried to differentiate themselves and also to attract more international investors, as well as more high net worth individual and family offices. To fuel their growth, indeed, private equity aimed to tap into the 2 trillion euros of saving of Europeans.
Very good. And how much is ESG integrated in this fundraising environment? Is it really a plus, a constraint?
Yeah. ESG is now completely core into private equity strategies. In 2022, there were more than 1,000 private equity and venture capital firms that were signatory of the United Nations Principle for Responsible Investment. This is 4 times as many as 5 years ago. And in a survey conducted by Bain and the ILPA, which is the Institutional Limited Partner Association, we see that 70% of LPs say that they have integrated ESG into their approach. They are more and more demanding towards GPs.
Very good.
And 85% of these GPs, they have integrated a specific ESG strategy into their private equity portfolio. And our clients aim to differentiate themselves also in terms of ESG. They are becoming more and more sophisticated in terms of ESG. And for instance, they are launching funds that are not only dedicated to energy transition, but also funds dedicated to ocean protection, biodiversity, education, food transition. So we are seeing a lot of things happening, and we are the proud depository of a lot of impact funds.
Very good, very good.
So Stephane, you started talking about the valuation market. Can you tell us a bit more on how the LBO market in terms of M&A, deal flow and syndication is going on currently?
Sure. Well, we continue to see significant pressure being put on the deal flow and the multiples. The one very simple element is that higher interest rates, I mean, usually we had a 450 basis points margin over a very low LIBOR. That amount has doubled. So today, the amount of interest expense on a portfolio company, and you all know that quite well, has doubled. We're close to 10% or more. That is a significant impact on cash flow. When you value a company on cash flow, obviously, that is going to have an impact, even though we do EBITDA, which is before earnings and interest. But that still has an impact on the amount of debt that you can put on a company. The lower amount of debt that you can put on a company, especially in today's market, which is a bit concerned on the exit, on the multiples, on over-gearing, and so it's more difficult to raise large transactions in today's environment, clearly has an impact on valuations. And the more we have an impact on valuations, the more this circle starts eating into itself, because the lower the valuations, the less of the companies you can sell. Because we are in a large secondary environment where sponsors do sell to other sponsors or to trades. And so clearly the impact of that is that there's less money flowing back to the LPs because there are no exits. Since there are no exits, fundraising remains difficult. And as you can see, the system is always catching on itself. So what are the impacts that we've seen? Lower valuations, but clearly an increase in trade players. Even though, if you look at the exact data, the market share of sponsors remains at 42%. That's across Europe. 42% of all transactions are made from financial sponsors. Even though the amount has come down significantly, it remains at 42%, which means that we're a very resilient industry. We will come back. But trades are clearly having a good time. Clearly, then we're privileging those that have a new fund, that therefore have the time, the ramp up, and the balance sheet to support buy and build strategies for their best companies. Now is really the time to make sure that your portfolio companies are really making a large consensus in terms of acquisitions, growing their size, growing their product range, growing their range. Then the last point, which also goes to the valuation, is when you do a deal today, when a sponsor is doing a deal today, it has to be a good deal. You are not going to go to the IC and saying, maybe if we're lucky, this is going to go do a 20% IRR. Never. The boss is going to say, is this going to be a good deal? And you better say yes. If not, you just don't do it. There's no pressure today to deploy a lot faster. So that's one point. The other point is, since you're confronted with that concern on deal flow with which I would call this external factors, what can you do to your portfolio and to your LPs to improve that? So we've already talked about the bolt-ons. Other items that have been proposed by large and very nice investment banks like ours is obviously the fund finance sector. You know CACEIS very well, and you know CACIB. We're European leaders in the fund finance sector. But we've developed a number of other products, including GP financing. That is to make sure that as a GP, you can maybe participate in a consolidation of the sector or increase your balance sheet to be able to commit to those new strategies that you've been putting on forward. And as a matter of fact, we will be hosting a panel during IPEM with TKO, with ICG, with Oaktree and B Finance. And the impact of the strength of your balance sheet as a GP will obviously be a key topic. Come and join us. That will be on Tuesday morning. But in addition to the balance sheet, we also have other items like NAV facilities. We've all been talking about NAV facilities for the past 2 or 3 years. Now they're clearly kicking in. Obviously, some people are using it in a bit of a re-leveraging of the fund. I'm not sure I truly share that point of view, but it clearly is a tool that GPs and fund managers can use to continue growing their portfolio companies without having to raise a new fund. So those are some of the sectors, some of the elements that can be put into place. Other items, and we've seen a lot of growth in that, is continuation funds. If you have a very nice business which is growing, has a long trend of expected continued growth, consolidation that is possible, the natural element today is not to sell it at a discount. Why would you do that? You put it in a continuation fund. And today, a large number of portfolio companies have been put into continuation funds, and continuation funding from a GP point of view is one of the new recent niche sectors in which some people have clearly taken leadership and clearly shows that the industry is moving away from just plain large transactions into a number of niche segments. We have continuation funds, we have capital relief funds that have come to support banks in terms of their need to provide a relief to their balance sheet. We have a number of sectors, for example, very focused sectors in tech, in healthcare, and a few other sectors like this, which are clearly sectors that are new and attractive for which LPs are going to be spending some time. And last point is clearly on syndication. Syndication is difficult, but even though we see a lot of direct funds coming in and doing the syndication, we think that over time there will be a mixture of direct lenders who will participate in funding and a number of in syndication markets which will come in. But a big question for everybody is what's next for LPs? If LPs are today at a constraint, how are we going to grow the industry? We have to continue growing. So a question to you, Olivia. What about retailization of the private markets? Is that happening? Is that really the new Eve coming up?
Yeah, definitely. And just before, I want to mention that we are indeed seeing at CACEIS more and more continuation funds, direct lending funds, and all the above that you mentioned. So the trend is clear all over Europe. Regarding retailization, administrative barriers, high investment threshold and lengthy lockup periods have long prevented individual investors from participating into private markets. Recently, GPs have significantly decreased their minimum tickets requirement, but now GPs want to go one step further into the retailization to tap more family offices, high net worth individual, and also retail investors through life insurance, for instance. So in the US, for instance, the SEC expanded the definition of accredited investors in 2019, making it broader for individual investors and easier for them to get access to private equity. In Europe, we will have the new LTIF regulation, which will allow to market this product differently to both institutional and individual. Regarding the LTIF framework, there are 6 features that all of you must know. First of all, the LTIF 2.0 reform broadened the range of eligible assets. And it provides a simple definition of what are real assets. It provides more flexibility in terms of strategy. Indeed, the regulation reduces the minimum threshold of long-term illiquid investment assets from 70% to 55%, which allows for an increase in terms of liquid assets from 30% to 45%. The minimum threshold of real estate is removed. Now, co-investments are permitted. There is as well the possibility to invest in green bonds, in simple securitization. And final feature that you must have in mind is that this new regulation will be effective from January of next year.
Okay.
So we start receiving incoming calls from our clients to work on LTIF projects and on hybrid funds. What we expect is that blue chip asset managers may benefit the most from retailization, as they have the brand to attract retail investors, and they have the scale to invest in people and technology to deal with this kind of funds.
Very good.
So Stephane, let's tell our audience what are the top priorities of your clients, the deal makers, investor relations for this September.
Sure. So I think I touched on it a bit earlier, but I think clearly when you're a GP today, you want to make sure that you're spending your fund, you're allocating your fund in a very smart and an attractive way, that the companies that you're buying are going to be attractive, they're going to be liquid, that there's plenty of ramp up for buy and build going forward, and that they stick to your investment strategy. I think clearly what has made the success of leading players like CVC, like Cinven, like Clayton Dubilier, that have been very focused on just private equity, or others in the infrastructure space, like Antin and others, is clearly a very strong focus of exactly the message and the investment strategy that they want to put in place. And I think that is very important to be consistent with what your LPs are expecting. That's number one. Number two is to make sure that when you come into a transaction, as I mentioned earlier, your pricing is attractive. You have to make a good deal today. When you come in, you can't just be on the fringe of hoping that the deal will be good. That just doesn't cut mustard anymore. You have to make sure that your deal is going to be a good deal out of the box. And that you will be able to consolidate. And then the other issue is going to be that it's going to hit a lot of GPs is, I have to give money back to my LPs. We've talked about NAV financing, we talked about fund finance, we talked about GPs and others, we talked about continuation funds. All these are elements which can provide some liquidity to your portfolio companies. But the next point is going to be, you're still going to have to make some decisions. CVC clearly showed the route that you can raise 25 billion and to provide, but CVC is the European leader in private equity. And as such, in today's market, there's a flight to quality, there's a flight to brands, okay? Not everybody can enjoy that position, whether it be in their own space, in infrastructure or real estate or others. So if you're not in that, if you're not in the top three, what are you going to do? Well, I think that your investor relations has to double the amount of effort. We talked about retailization. There are a number of possibilities that could be made available through private bank, through life insurance vehicles, a number of items that can be put in place. But that means that your existing LP base has to be very happy with the work that you're doing. You don't have to over-prioritize them, but you have to make sure that they're pleased with the information that they're getting. And then you're going to have to do some efforts on your portfolio. You're going to have to sell some of those companies, even though you're not going to make the top buck. You might want to give some money back to your LPs to make sure that your fundraising cycle continues, because you cannot afford to stop that fundraising cycle. Or you're going to have to take a decision that your fund, that your upcoming fund, is going to be lower. And I think a lot of GPs today realize that their new fund is going to be at a lower amount than their last fund. And maybe the next one will also be lower. But the issue is, survive. Like Netflix would say, drive to survive. Here is invest to survive. We will continue to do that. So those are some of the main drivers that we see in the industry and we see and expect coming up. So we talked about investor relations, but what are the hot topics for CFOs of GPs coming up?
Happy to share a complementary view of what you just explained. CFOs have expanded their influence toward more strategic function. And as you mentioned, CFOs are playing a more crucial role in managing margins because they have to expand the platform in order to keep increasing the EBITDA of the GP. So currently, 22% of CFOs are reporting a margin erosion according to EY survey. And in response, Asset management companies are using 4 levers. First, 72% are investing more into technology. 62% are outsourcing to service providers like us. Some of them also adopting cost-cutting measures, but the bulk of them are targeting product expansion to maintain profitability. And as a consequence, CFOs are spending more time on corporate debt raising, GP stake to prepare managerial transition, and also to provide the means for 3 acquisitions of private asset funds to diversify their income, improve their margin base, and leverage on their existing platform. Eventually, talent management is very high on our clients' CFOs' agenda. It encompasses attraction and retention of talent. The bulk of the recruitment were done last year. However, there is still a lot of work to do in terms of new joiners integration and maintaining the corporate cultures. Stéphane, I think we have provided our audience a good snapshot. Thank you.
Thank you. Thank you, Olivia. Thank you all for listening. Do come to our booth. We have a fantastic booth. There's a little bit of coffee if you're feeling a bit down, and we'll come and perk you up. But do come and see us at the IPEM booth and listen to us on the various presentations that we'll be doing. And with that, we wish you a great day and a great IPEM in particular. Thank you.
Thank you.